Can y'all hear me now?
Yes.
Oh, okay. I'm sorry about that. Welcome, everyone. Sorry about that. My name is Labrita, and welcome to my podcast, Buying and Selling with Bri. I'm a realtor in the Dallas Fort Worth area. I have been a realtor now. It will be 10 years, October the 31st. Um, Tonight, I'm going to start this off a little bit different. Usually, I'll, say some things about the market and, what's going on. But there's been a lot of questions about the loan process, the interest rate, the different type of loans. So tonight we have Miss Chalamaine Armstrong. She is the division vice president for Go Financial in the Dallas Fort Worth area. So any questions that you have, just ask her, and trust me, she will have all the answers. She will talk to you about the different type of loans. She will talk to you when, if we have enough time, about the different down payment assistance program, and just the future of the market is where it stands right now. Hi, Chalamaine. How are you doing? And welcome to my show.
Hello. Thank you for having me. Hello, everybody.
Right now, I'm going to start with the questions until some come across.
Okay.
The market has really changed, and the interest rates are high. How are you as a lender? What changes have you seen? With the market, with the conditions that they are in now.
Great question. It's definitely a hot topic, right? A lot of tea to go with it. So, the raising of the interest rates, obviously, to curb inflation, and it's definitely made the rates a lot higher than we've seen and what we've been accustomed to. That being said, how I'm handling it is basically, really trying to make, I hate to say make light, but you kind of have to make light of out of the situation, and that you are in this market really paying for what you find value in. Meaning, if you find that home that you like and love, you're buying that home, you're making a commitment to that home, but not to the rate, because refinancing is something that has been around for eons. And that gives a person the option to obviously reduce their rate, or maybe extend the term to lower their payments, take cash out, shorten the term. There's all these different reasons why a person would refinance. But the biggest one is to take advantage of a lower rate. So right now, what I'm explaining is that, again, you're going to be paying for what you see value in, and that's the home. And in this market right now, there's not as much competition. So people are really able to purchase the home that they really want, but rushed to accept a home just because they got their offer accepted.
Okay, let me ask you a question. Being that the interest rate right now is at 7%, some buyers and some lenders, some of the buyers are getting less than that. Can you explain why some buyers can get less than what the market rate is now?
Great question. So really, there's a couple different factors. The very first one, which you mentioned a little bit ago, was down payment assistance. And there's a lot of misinformation out there when it comes to down payment assistance. And that is, the biggest one is, oh, well, get your credit score as high as you can so you can get a good rate. Down payment assistance does not care what your FICO score is in relation to a good rate. So the state of Texas controls what the rate is for everyone. So if you have a 620 score, 640, 660, 680, a 700, 720, even a 780, everybody's going to have this same exact interest rate. How down payment assistance works, the interest rate will change based upon the amount of assistance you receive.
Okay.
That the rate will be higher with more assistance. So right now, today, the rate to get 2% assistance through the state of Texas would be 7.25.
Oh.
And that's the same for everybody, whether or not your score is a 620 or an 800. There's no prize or no benefit to having a higher credit score when it comes to down payment assistance.
Oh,
Then when we take down payment assistance off the table and we talk about the fluctuation of rates, maybe
mhm.
somebody may get a 6.625, a 6.75, or a 6.875. Now that's when your interest rate would be based off of your FICO score, meaning that another misnomer is that interest rates are completely different. That's what you're asking. Hey, why does
Yes.
this one person get this? Well, the interest rates are the same, but the cost to get that rate varies based upon the credit score, meaning that there is risk associated with the credit score. So a person with a 500 credit score can get a rate of 6.625. They just have to pay the risk associated with that rate. So maybe a person with a 500 credit score may be pushed up to 7.5 even. And that is
Okay.
because the cost to secure that rate would be too much at a 6.625.
Okay. Okay. The other question I have is like the interest rate is at 7.25. What
Well,
is with down payment assistance? So what is the market rate to right now this morning?
so today a person could, get 6.625% if
Okay.
they pay their own down payment.
If they pay their own down payment. So like a lot of people, some when the interest rate went up, it took a lot of people out of qualifications because a lot of people, when it was 3.5% versus the 6.6%, how much more of a house did it increase their house payment?
Great question. So I like to do things based off of percentages. It makes it easier. And then, of course, I sound smarter.
Okay.
We're going to accept that. So, so basically, back when the interest rates were really low, a person could, acquire a home and typically the old saying was that if you were going to rent, you're going to be paying 1% of what that home is worth. Now it's more like 1.22% of
Okay.
what a home is worth because rents have gone up,
Mhm.
um, in some cases 33 to 40%, along with the higher interest rates. So today's market, when you're going to own a home, that factor is 0.93%. So it's not quite, it's still cheaper to own than it is to rent. But we are obviously closer to that 1% rule, meaning that what the home was worth would be what you would be paying. So 0.93 is where we're at now. Where we were when the market was lower, we were kind of at like 0.63.
Okay.
Um, and that includes everything: your principal, your interest,
Yeah. Yeah.
taxes, insurance, and mortgage insurance. So if a person wants to know what their payment is safely today, let's
Mhm.
say they were going to be looking at a home that was 100,000. We know that doesn't exist, right? But on $100,000 home, if they took that 0.93 and times it by that, then their payment would be $930. So that's just a good way for and not just in Dallas. I saw in the comments,
Yeah.
uh, anywhere.
Yeah.
Um, and we're licensed in several states, so it can be anywhere. And again, that factor, it holds true right now for you to get a good estimate of what the principal, interest, taxes, insurance, and mortgage insurance would be with a very minimal down payment.
Okay. What is the you have FHA, you have conventional, you have USDA, you have VA loan. What are the buyers that come through you? What are you mostly approving them for? Or
Uh-huh.
is it still based on their credit and their debt?
Okay, good question. So we I like to say that we are a basically a custom lender. So we're going to first and foremost determine what that person's budget is,
Mhm.
and then by knowing what their budget allows us to put them in a vessel to get them that home. So
Okay.
some clients, it may be a conventional loan, some FHA. Obviously, to get a VA loan, you have to be a veteran, or
Mhm.
surviving spouse of a veteran. USDA means that you have to be able to purchase in a rural area. And each guideline, there's some little different nuances. Probably one of the biggest ones that would maybe work on FHA, for example, is that we can land down to a 500 credit score. One of the things that's a benefit for a VA loan is that we have no minimum credit score, meaning that a person could have a 500 credit score and still
Okay.
get financing.
Okay, it says we have a question here. I think you can see the questions too. It says, what's challenging for your clients right now?
Okay.
And what examples can you share?
Okay, great question. So, what probably would be what's challenging is a lot of people have picked up other jobs because things are more expensive, right? So, with that being said, some of the different programs have different requirements. So, for example, a conventional loan will allow you to qualify with 2 jobs with only 1 year of you actually working both of them simultaneously. So again, conventional financing, if a person works 2 jobs, as long as they work them both simultaneously for 1 year without any gap,
Okay.
both of those jobs to qualify them.
So this is for conventional.
Right.
Okay.
Very conventional. Then FHA is a little bit more difficult when it comes to working multiple jobs. FHA requires that you have 2-year history working 2 jobs.
Okay.
So that's probably a very common thing right now. Again, is people working multiple jobs to either pay off debt or just to, maintain, just because things have gotten, very expensive across the board. Another thing in Texas specifically, Texas is a community property state. So a lot of times people will say, well, I want to go on the loan by myself, and I do not want my spouse to go on the loan with me. Well, in Texas, they don't have to go on the loan with you, but anything that is acquired during your union, you both equal interest in when it is a primary residence, when it is called your homestead. So if it's your homestead, it's your primary residence, then you have to qualify with your spouse's debt, even if they're not going to go on the loan. So those are probably the 2 biggest things that we're seeing.
Okay, I have a question. I'm getting back to the job thing. So what if you have your own business and you can't qualify for conventional, but you can qualify for FHA, but you've been in the business right at a year, maybe a year and a half? How does that work for somebody that's self-employed?
Great question. So if they actually have what's called a 2-year history doing whatever their business is, then we can get by with 1 year's tax returns. A lot of people, that you have to have 2 years tax returns, and you do not. So, for example, someone who's a truck driver, let's say they work for I don't know, Averitt Express, and then they got their own truck. They've been doing it for a year now. We just have to have that tax return that's going to show 1 calendar year. And then that 2-year history to show that they're doing what, what they have experience doing.
So it doesn't matter if it's FHA or not, even if they qualify, if they don't qualify for conventional and do qualify for FHA, they still have to show for FHA loan 2 years. Like that last year may have been self-employed, but that other year they may have been working for UPS or the post office as a truck driver. Then they went out on their own. So they still have to show that they was in that same field.
Right. Yes, correct. Because people think that you have to be at the same job for 2 years, and that's not correct. You can have several different jobs within a 2-year period. The 2-year period is just to establish that you're used to working. That's it. But it does not the same job.
Okay, everyone, it is storming here where I am, so we might be going in and out just a little bit. I just want to let you know. But we do have a question. It says, does the income type matter based on the loan type?
So it does not. There are many different types of incomes, and I like to kind of separate them. Like for example, you can have passive income. That's allowed. And passive income is meaning income that you receive that you don't necessarily have to work for. So Social Security, disability, child support, alimony, a trust income. Those are things that you would get without per se any effort. And then, you can have a W-2 job, a salary job. Even in instances, we can use unemployment in their income calculation if that's something that they've done historically. So I'm going to use GM, for example. They shut down the plant every year for a couple of weeks. So if that person was filing unemployment during that time, then we would use that because it's something they have historically done.
Okay. I have one more question. When you was talking about truck drivers, what if the couple is not married, they've been living together, and they both work, but he can and he wants to do the house by himself? Is that possible?
Yeah. So I just kind of go back to, you can again have, anybody, you can have up to 4 people on a mortgage loan. Okay. All right. So that's one thing that a lot of people don't know. You can have 4 people on a loan, and you can decide who within the family you want to go on the loan. So it could be the truck driver and the kid, the truck driver and the mom, the truck driver and the grade. You can have 4 people on a loan. It does not matter whomever. What the goal is for us to customize the mortgage to allow you to be able to purchase the home. That is what the goal is. So the truck driver, as long as, we can verify the income, and that's the biggest thing, you guys. We have to be able to verify the income. And that's another obstacle that we may come across. Someone may have a business and they're doing really well, but they're not filing the tax returns for that business, or they're filing the tax returns for the business, then they're writing off all the income. So when we're trying to qualify people, especially if they're self-employed, that say, 100,000, but then they wrote off 90 of it, then we could only use $10,000 of the income. And so that can be, that's where a lot of times somebody who is a truck driver or a self-employed, well, we have to add people to make it work.
And sometimes that don't necessarily apply to just truck drivers. It applies to everyday people that are working because they want larger refunds back. So they write everything off. So, and I'm glad you said that, because for the, if there's people on here that are listening, remember, it's your adjusted gross income that the lender is going to go by. So it's not your gross, it's your adjusted gross income. And let me say this. When you were saying that 4 people can go on the loan, those same 4 people still have to do a credit app and qualify and still go through the same process as 2 years of jobs, or will they be able, do they still have to have 2 years or whatever employment, or can they just be 1 year?
Great question. So it's the standard for all mortgages is 2, 2, and 2, meaning that we're going to verify where you've lived at for 2 years. We're going to verify where you worked at for 2 years, and we're really focusing on your credit for the past 2 years. Now, in that process may gather more information than 2 years. For example, a lady's application I took today, she'd been working at the airport for 6 months. Then prior to that, she worked at Home Depot. Then prior in school, and then prior to that, she had a job. So we actually end up having to basically get 4 years to verify 2 years employment. You know what I mean?
So being that she wasn't in the same field, you all would still maybe can still approve her?
We can. Again, continuity of employment, customer service is customer service.
Okay. That's how you did that job. Okay.
Yeah. So basically, where there's an issue you're talking about a person's skill set would be
Uh-huh.
if I am a salaried or hourly employee, let's see, working. I use Home Depot, for example. I'm salaried
Okay.
at Home Depot. I quit Home Depot and then I go work at Nordstrom's in the shoe department. My hourly rate is $11 an hour, but I get commission and my commissions are huge, and I really need those commissions to allow me to qualify. Well, if I don't have at least 12 months of receiving that commission, then I can't use it, you know.
Okay.
That's how overtime, bonus, commissions have to be received for at least 1 year and
Consecutively.
use it because they are production based.
Okay. Now,
Or
what if that person gets a big bonus at the end of every year? So, say for instance, some jobs give out a big bonus in December.
Mhm.
And so, how would you calculate that person that get that bonus that once a year? Do you go by the same amount, or how do you average that out? Because some jobs do it every 6 months and some jobs do it once a year. So, how do you all do that?
Well, since it's production based, we have to average the income. So if it's paid at the end of the year, it's still averaged over 12 months.
Oh, okay.
I use
Okay.
round numbers so I can sound smart. If bonus, was, we'll say $6,000. That
Okay.
means that we would add an additional $500 a month in income because
Okay.
over
Okay.
months. So if a person's getting a bonus in December and they've never gotten a bonus before and they know what it's going to be, the employer would have to say, yes, on December 15th, they're going to get $6,000 unequivocally, no problem. But if they can't do that, then we would have to wait for them to receive the bonus in order for us to use it.
It has to actually show up in their paycheck in order for them to do it.
Well, not necessarily. A lot of people don't know this, but if the employer will verify a raise or the bonus, and if
Mhm.
it's within 60 days of our closing, then we
Oh,
can use it. And I've done that before several times where we needed every penny, and we were like, "Oh, you're getting a raise in 60 days," and we're closing on. I'm just going to use this as an example. Let's say we're going to close on November 15th and your raise kicks in November 30th. Well, we could go ahead and use that raise because your first house payment, if you
it's not due
for
until
15th, wouldn't be until January. So
mhm. Mhm.
take effect prior to your first house payment. So again, a lot of people don't know that, but if a person's getting a raise, you don't have to wait for the raise to close. As long as their job will verify it, we can use it even though you don't have it.
Oh, okay. And I'm looking at a question here. It says, "Are you seeing more investors buying homes now, or more families are now able to buy? It seems to be a struggle beating the investors out of a deal." Let me go on the realtor side.
Mhm.
Um, yes, they are buying. Both sides are seeing a struggle because of the buyers are seeing a struggle because of the interest rate. The buyers are seeing a struggle because of, a lot of people just don't have the money for down payment. And for as investors, it's just not a lot of investment properties out there like it used to be. So investors now are just buying, regular homes, and they're leasing them out. So the struggle is still more, and it's really hard to say, but I still think the struggle is probably more for the buyer than it is for the investor. Because they just come right out and they just buy cash. But a lot of times now, some sellers are just, maybe it depends, maybe not wanting to sell to investors. Maybe they want a family to buy their home. So it really depends on the seller that is selling a home.
Gotcha.
What is your advice to be a new real estate agent? You can DM me and I can speak with you about that offline. Miss Charlamagne, another question. The FHA loan is mainly for what type of buyer?
Great question. So the FHA loan is for any and all buyers. It's not geared towards any one specific type of buyer. And FHA loans are green, meaning they spend just like any other loan does. I think during the pandemic, FHA unfortunately kind of got a bad rap. They, felt like, well, if a
Yeah,
person,
they did.
is using FHA financing, maybe their credit is bad, or maybe, they're getting down payment assistance. Um, Maybe, just all the things. Oh, and probably the biggest one is that FHA does not have an appraisal waiver. Okay.
Right, right, right.
And that's really what in the market, what if they were wanting, hey, we're going to bid over $50,000. We want an appraisal waiver. So no matter what, the property appraises for, you're going to still buy the house regardless.
Yes. But that market right there is gone. But, people still are paying just a little bit over, but they're not doing that anymore because there are a lot of houses that have been on the market now for 30 days. Sellers are doing more negotiations now. Some sellers are even helping to pay closing costs. And some of them still not paying, but some of them now are more willing to say, hey, I asked for $2,000, and some of them will pay. Whereas January or December last year, you couldn't get anybody to do anything. People that did have FHA loans, they were just out of luck. And speaking of FHA, that's why maybe she can verify this. That's why a lot of buyers, for FHA buyers, were going to new instruction that they could afford because it was just FHA. That's what I saw. Is that what you saw as well when they was getting kicked out of the market, or just kind of even?
Yeah, it's kind of six half dozen one the other. It really just depend on, to me, a lot of people were trying to jump into the market. So that new construction allowed them to kind of gauge when that lease was going to be up on their current residence. So,
Yes.
if it took 9 to 12 months to build, it was okay because they just signed a new lease anyways, So that's where that new construction market definitely fit into most people's timeline.
It did.
And to extend it out as long as it needed to be. Some instances too long because we were like, okay, hey, my lease is up. It's been 12 months and my house still ain't done. So, but going back to your question, FHA is for any and all buyers. It's not necessarily catered to a first-time home buyer. You can be a second, third, fourth-time home buyer. I have one client right now who's very distinguished buyer and has done her homework. And like, what? I love the security that FHA gives me because if I would ever run into a financial situation, FHA is going to provide me counseling. FHA would even allow me different options to get caught back up with my mortgage or modify my mortgage. Whereas on a conventional loan, there is not that support there like it is on an FHA loan.
That is true.
And so she was like, you know what? Based off my job and my career, she was like, I don't care that I can get approved for a conventional loan. I want an FHA.
Okay. So conventional loans, what type of buyers are usually getting approved for that type of loan? Because those are the two type of loans right now, FHA and conventional, of course, VA, USDA. So conventional loans are mainly for which type of buyer, what type of credit score, of course, on both sides is income, but what type of buyer usually gets approved for conventional loans?
So if you're going to be, so conventional has kind of changed a little bit in that, in an effort to grab or to move people over to a conventional loan versus FHA, conventional allow for what's called blending of credit scores. So, yes. And so with a conventional loan, you could take someone now who has a 550 credit score and someone who has a 720 credit score. And let's say that blended score was 640. Even though someone had that 550 score, they could still get conventional financing. Okay.
Oh.
And so the type of buyer that would be doing a conventional loan, typically what we saw in this market was going to be that buyer who was putting down a larger down payment, to be honest. Maybe someone who sold their home and was purchasing another.
Mhm.
And so they wanted to maybe put down 10% or in some cases 20. But with a conventional loan, you still can put down as little as 3% and get that conventional loan. Um,
So on the FHA loan, the minimum down payment is 3.5%, correct?
and there, that's correct, 3.5%. And there's a big misnomer when it comes to mortgage insurance,
Mm-hmm.
comes to FHA versus conventional. Most people think that, I think there was a question that came across the screen that with a FHA loan, that the mortgage insurance would stay on the life of the loan, regardless of if any down payment or anything like that. And that's not the case. With FHA, if a person puts down at least 10%, then the mortgage insurance does not stay on the loan for the life of the loan and actually will fall off at that 80% mark, just
Okay.
like a conventional loan would. I've seen this question came up again as far as a mortgage longer than 30 years. So yes, ma'am, there are mortgages out there. I couldn't see who asked the question. So
It was just
okay,
a regular Facebook user.
okay, perfect. I didn't want to say yes, ma'am, but it was a man or, so, pronouns. Okay. So 40-year mortgage is out there, but a 40-year mortgage is not a QM mortgage. And QM means a qualified mortgage. So Fannie Mae and Freddie Mac, which are the two purchasers of mortgages, and Ginnie Mae and so on, all the Mays and one Mac, they do not insure or purchase mortgages that are longer than 30 years. So a mortgage that is longer than 30 years is more of a portfolio product and
Okay.
is called a non-QM loan, a
Okay.
non-qualified mortgage, meaning that any lender that would offer that mortgage would actually service that mortgage. And so your payment would be made to that particular servicer. We do offer 40-year mortgages, but they are, again, since it's non-QM, it is at a higher interest rate and a larger down payment because that term is just not, it's not one that Fannie Mae or Freddie Mac actually recognizes.
I got a question on the down payment assistance. This was asked last week. When you get down payment on FHA and conventional, is there a certain amount of time that you have to live in the house before you sell it, or is it 2 years, 3 years, 4 years, or 5 years, and then you can sell your house?
Great question. So if you are within the, AMI, which is the average income median limit, you can be purchasing in a targeted area or a non-targeted area. Most of the programs, and again, I say most, allow you to get a grant, and the grant is forgivable after the recapture period. So the recapture period typically is 3 years. And again, I say typically or most of the time. There are some programs where the recapture period could be longer, but typically the recapture period is 3 years. So if you make 3 years of on-time payments, then that assistance slash loan that you receive would be forgiven. If you're over the average median income limit, then you could still receive down payment assistance. Like I have a program right now that has no income caps or limits.
Oh,
So
wow.
$200,000 a year and get down payment assistance. Okay. But that particular individual would actually have a repayment on those funds because they're obviously over the average
The
income.
threshold.
Yeah, the limit. So they would have a repayment. So that being said, with all down payment assistance programs, and again, this is all, not most, there
Okay.
is no prepayment penalty, meaning that you can refinance at any time. There's nothing stopping you from doing so. The only caveat is that if you are to refinance before the recapture period, then you would have to pay back what it is you borrowed, which in most instances, prayerfully, you would have the equity in the home to pay that back. Or you may say, you know what, I don't want to pay that back, and I'm going to wait my 3 years. And henceforth, and I'm backtracking now, why the interest rate is the same for everybody, because nothing is free. Okay. If they could figure out how to charge us for COVID-free air, they would. Okay. Air, they charge you for that even, right? So that being said, that's how they actually fund all the down payment assistance programs. Each state has what's called a general fund, and
Mm-hmm.
fund houses these funds. So while they are letting people borrow from the general fund, how they're replenishing those funds is at a higher interest rate than the market rate. And so that's paying for the people that they have there in the office to facilitate, obviously reserving these funds and making sure that these funds are there for each individual.
Okay. The other question I have is with new construction,
Mm-hmm.
the builders are giving all these incentives, this amount for down payment, this amount for down payment. How do you compete with the builders as a private lender?
Very good question. So, in my opinion, we compete very well because we're educated, and, we are not just pushing numbers. We really are dealing with the client.
Mm-hmm.
And now, because the market has shifted, honestly, the builders are allowing families to use
Yes.
outside lenders more than they were during the pandemic.
Yeah, they are.
What I just caution people is that, a lot of the builders, because there were so many people waiting in line to purchase these homes, hey, if the house is done and there's an issue with your loan, they're going to bump you and put you on another house and make you wait. I
Yeah,
had people call me just for like, oh my gosh, what can you do? I'm like, hold on, let me fix it for you and let me get you closed. So, our closing ratio is a lot better than the builder's lender. And we can pay title, and we were paying title. And then in some instances, we were still able to match up to a point, as long as they were not, using down payment assistance.
okay.
Because down payment assistance, again, is set by the state, and there are some of the rules there. So if they were paying their own down payment, then we could definitely, assist, and, up to 1% plus title. And we offer what's called a mortgage credit certificate. And that
Yes. You
credit
see.
certificate, gives you 20% off the property taxes. I mean, the builders were not offering that. So, like in one family, we got them $90,000. The builder did not offer that to them. And they're like, so you're going to pay title, and they were using down payment assistance, but they're like, wow, it wouldn't make sense for us to walk away from $90,000 over the life of the loan to get $5,000 up front,
And a lot of times the builder, even though they can still use their outside builder, most builders still want you to qualify through their builder, because even though the market is like it is, and it has changed a little bit, some of them will try this tactic. I don't know if some of the new construction have been to you. Well, if you don't close on this day, we're going to charge you this day per day.
Mhm.
So have you seen that come across your desk?
Yeah. So, yes, especially when, people were, kind of like flocking to the builders. Yeah. They would put penalties in place. They would charge people $50 a day, $100 a day, and people were having to pay that, Now, I don't think they're going to charge penalties, but yes, I had seen that.
Yeah, because one builder, I talked to her the other day. She said they got 400 houses sitting on the ground, and they're giving a lot of incentives and everything um, to get rid of these houses. I know you asked a lot of questions. Can you give out your information again?
Yes. So, Chalamaine Armstrong, Gold Financial Services. I'm the division vice president for Gold. I'm the president and CEO of Kiss Wealth Now. My phone number 214-738-4913. And my website is Kiss Wealth Now. And my email address is carmstrong@goldfinancial.com. And I'm across all the platforms under my name, Chalamaine Armstrong. So YouTube, Facebook, Instagram, all of them, TikTok, Snapchat, you name it. So I put a lot of information out there as far as, mortgage tips, even daily, national days, things
Yeah,
like.
I see you. I see your videos, and I really like them. You are. She doesn't care. My friend Rose, she used you, and she had a new builder, and
Uh-huh.
she was adamant about using you, and she told them that, but she still had to do what she needed to do, but she was adamant about using you. I know some other people too, and they got new construction and they still use you. Other realtors we talk. So for those of you that are out there that are listening, if you want a new construction,
Mhm.
you can still call Miss Charlamagne. She will work it out for you. Now,
Builders am. So when they hear my name, like, okay.
yeah, and just be mindful, people that are listening. Your friend may say, "Well, I got this and I got that." Everybody will not be able to get the same interest rate. Everybody will not be able to get the same down payment assistance because everything depends on your credit and your income. You know, it's okay to listen to your friends or whatever, but you go to the professionals that know. And Miss Charlamagne is a professional. Everybody knows Miss Charlamagne in the Dallas Fort Worth area. So if you want to talk to her about a loan, just give her a call, um, and she will help you. Any upcoming classes for home buyers or program in the Dallas area? No, but there is one coming up on February the 12th. You can inbox me. Um, you can call me at 817-975-9284. We are having one here in the Fort Worth area. Miss Charlamagne, do you know of any home buyers seminars that are in the Dallas area? Because that individual may live over there.
Right. I was going to say that a lot of people, since we're in Q4, the end of the year,
Mhm.
several people have tried to put on first time home buyer, but there was not many people signing up. So a lot of
Right.
people I've been seeing have been canceling those in this last quarter of the year just because the sign up is not there. So in this, if you're looking for some education, definitely we can do a one-on-one together with you and answer your questions. I want to point out one thing because you talked about credit that
Okay.
um, is really key in this market because a lot of people are having issue with their debt to income ratio,
Hmm.
right? Meaning that, for the amount of home that they're trying to purchase, their debt may would be a little bit too high. And
Hmm.
think that, well, hey, I'm down, I paid $1,000 on my debt, or I paid $2,000 on my debt, and that should be sufficient enough to fix my debt to income ratio. And I always have to explain to people that your debt to income ratio is not based off of the cumulative balance of what you owe. It's based off of your actual payments. So you,
Oh.
yeah, a lot of people think that their debt to income ratio is based off of how much they owe in totality. And
Oh.
it's the monthly payments. So a lot of times when a person says, "Oh, well, I paid $1,000." Well, if you paid $1,000 on your car, for example, but your car payment is still $500 a month, then your debt to income ratio would not change.
Okay. I have another question since you brought the debt to ratio up. if people, what do you recommend people payments on their credit cards? Like if it's $1,000, do you suggest like a person with DTI problems and you tell them they need to pay it down? What percentage do you want them to pay it down to?
Well, see, again, it's not a percentage because it's based off of payments. And that's something that we've got to, I want to, um, again, try to put this out there. So really, when we're talking about debt to income ratio, we're talking about dollars. We're talking about how many dollars that
Okay.
we need to reduce payments by.
Oh,
It's
okay.
not balances, it's the payments
Okay.
that affect income ratio. So a person could have $100,000 in debt, and let's say their payments be $1,000. Well, but if I need their payments to be $800 to qualify, then what debt can they pay off? I mean, in its
Okay.
totality to remove that payment because the
Okay.
debt ratio is based off of payments. So
Okay.
when a person says, "Hey, I have some money that I can use to help me, put my debt to income ratio in line," we have to see where we can apply those dollars to remove a payment. It's
Okay.
not, again, paying down the debt, it's the actual payments that affect what a person could qualify for.
So you as the lender, what would you recommend someone that's looking to buy a house? I always, when people call me, if they're not ready, I say, hey, start saving money a year out,
Mhm.
because of the way that the market is, or someone might be ready in 6 months. What do you recommend to a person that haven't been to a lender yet? They're looking at their credit card debt. They say, oh, this credit card is 1,000, this one is 200. If they want to pay off their bills before they come to a lender, do they start with the smallest amount to pay off? Like if they can pay 200 off and don't use it, or they can pay $500 off, how would you recommend those that want to come but still want to kind of do it on their own, how to pay their bills off?
Great question. So I say that, and this is Charlemagne's rule. This is not anybody else's rule, but it works. Okay. When a person's trying to figure out what they can qualify for, most people have a car payment. Most people have, a couple of small credit cards. So a person with average debt right now can qualify at about 3.5 times their gross income.
Okay.
And that leaves room for a car payment, credit cards, even a couple of student loans. If a person has hardly any debt at all, or may have no debt, then they can qualify at 4 times their gross income. So that being said, when a person's trying to figure out, well, how much can I qualify based upon my income? Um, then, and I'll use round numbers so I can sound smart, but makes $50,000 a year, doesn't have a car payment, very minimal debt in this market would qualify for 200,000, right? And they say, well, gosh, all the homes that I like and love are 300.
Yes. Yes.
How do I make this work? Well, then we start saying, okay, who can we add to the loan? Because the house payment doesn't change based up upon a person looking at homes that cost more. So that's where this other Charlemagne's rule comes into effect. If they're looking at homes that are 300,000, we got to take that 0.93 times that 300,000. We're going to have to move our decimal over 2 times or maybe 4 times, depending on the person's calculator, because we have
Okay.
4 numbers in front and then whatever's on the back. And so if a person says, hey, I'm looking at $300,000 houses, my realtor, it says I can get a $300, they can find me a $300,000 house. But they say, well, gosh, technically, I only want my payment to be $1,800 a month,
Ooh,
right?
now that's
That's
280, 250.
often, people say, well, I'm looking at homes that cost this, but I only want my payment to be this. And I have to explain that, well, let's calculate what mortgage payments are. And if
Yes.
you're looking at
Yes.
a price house, then you're either going to have to add someone to your loan, because we can have up to 4.
Oh, wow.
We're going to have to make a large enough down payment to impact that monthly payment or your debt to income ratio enough so you can qualify. And going back to, well, I got a couple of $1,000 I can throw at it, well,
Mm-hmm.
$1,000 is not going to help you qualify for a $300,000 home if you only qualify for 200. It would take tens of thousands of dollars.
Oh,
To be exact, it would take $100,000, okay, to go on that home to get you at your payment or what your purchase could qualify for based off that example of $50,000.
okay. We got a little bit more time. Got about 5 more minutes. Can
Okay.
you explain? Because this everybody usually have this problem. The student loans. How does that? How does that go? How does that working right now with you as a lender?
So in right now, many people are saying, hey, I did my application, I did the beta app, I'm waiting, my student loans will be forgiven. Well, with all mortgages, if it's not forgiven, meaning if it's not written, it's not so. So even though they're going to be or will be, or you're waiting to find out, whatever is on your credit report is what the lenders have to use, period.
Okay.
Now, with FHA, you have to qualify with 0.5%. So again, my round numbers, a person owes 50,000, 50,000 in student loans. They would have to qualify with a payment of $250 in their debt. Okay.
So do you add that debt if they don't have a payment agreement or if it's in deferment? Do you still add that in their debt ratio, even though they might be in deferred?
Great question. So, FHA specifically states regardless of the disposition, meaning regardless if they're deferred, forbearance, IBR, IDR, you still have to qualify with 0.5%,
Okay.
because at some point in time, you're going to pay back them student loans because it's going to help our $1 trillion debt issue, right?
Mm-hmm.
On a conventional loan, you're able to qualify as long as you are in a repayment plan. So if a person is not in a repayment plan, then they would have to qualify at 1%, meaning
Okay.
forbearance or deferment, you just qualify at the 1%. But if they're actually in a repayment plan and they can get a letter from their student loan company stating this is the repayment plan. So maybe a person who owes I will say $50,000,
Okay.
but the payment plan is $50 a month. As long as we have that in writing, then we can use that $50 payment a month on a conventional loan.
Okay. We got to answer this question. Somebody wanted to know, can they use their 401k as a down payment?
Yes, you definitely can. Great question.
The 401k, you can. If you have thrift savings, you can. But I do know with a lot of changes have come with that with my clients. Sometimes with the 401k, depending on your employer, some of them want to see the contract first before they will even lend you the money. I have dealt with that with like 2 people. Do you see that?
Right. So there's 2 types of withdrawals. So if a person is asking for a loan, then they would loan the money to them and they would have to pay themselves back. But if it's a hardship withdrawal, a
Okay.
hardship withdrawal with all 401ks requires you to document that hardship. So that would be with a executed sales contract
Mhm.
and the loan estimate from the lender to show what the cash to close
Yeah.
is, because then they want to make sure that whatever person would be pulling from their 401k, one, that they would have enough, or two, that they weren't just willy-nilly pulling
Yes.
it.
Trying to get enough money just to buy stuff because that's what happened with my client. He ended up not getting the house, but he was trying to get enough for buy stuff. And I guess they was like, no, your lender said this and this. So he pulled out. So, buyers beware, when you have 401k, it's everything has guidelines and everything has restrictions, even with the lender and, and the title company. And if you have any questions about, like, if you're looking for a realtor, you can just give me a call at 817-975-9284. But when it comes to the lending side, I make sure that I guide my client to the lender, because that's not my profession or anything like that. So if you're looking for a lender, the information is on the screen. Is Chalamaine Armstrong. Her office number is 214-453-4200. Her mobile number is 214-738-4913. And her email is carmstrong@goldfinancial.com. If you would like to speak with me, my number is 817-975-9284. You can call me, or you can email me at labrita.theklsgroup@gmail.com, or you can just inbox me from my podcast.
Yes.
Ms. Chalamaine, I want to thank you so much for coming on, asking questions, answering the questions. Hopefully this helped, but it's just never enough information. I mean,
Right.
It doesn't matter. You can just hear the same thing over and over again, and sometimes people still don't get it, especially when it comes to the down payment assistance, especially when it comes to, the credit or whatever. If someone is needing a credit person that is listening in, do you have a specific person, or do they need to call you and get that information?
Yes, if they can reach out, because I like to, and I know this is probably going to sound bad, but I'm per se not a believer in credit repair.
Okay.
Okay, but I do have a referral partner that I do work with, and when you're trying to improve someone's credit, the steps have to be very strategic. We want the steps to be strategic because the goal is for the score to increase. So if a credit repair company just goes out there and blanketly just starts messing with stuff, people see that their credit score will go down versus up. So I like to be a little nosy, I should say, but this specifically needs to be done.
It's okay. She will be back. There she is. Go ahead.
All right, so I like to say specifically what needs to be done, so therefore we can get the score increase that we need. It's so important, especially if a person's doing new construction. And in my process, I've had people say, hey, I found my perfect home. I'm like, okay, you got this one thing that we need done, and I get them to my third party, and I said, hey, this is exactly what I need done, and they get it done within a week or two, so we can close. I just had someone close last week. Their score was a 550, and my credit repair guy was like, okay, I can do it. I'm like, are you sure? He's like, I got it. And their score jumped up to almost a 640 within 2 weeks. So again, it just be a one-on-one, because I like to pull the credit, look and say what it actually needs to be done.
Thank you again, Ms. Chalamaine, for coming on. I really appreciate it. You're just giving out so much information. Again, you can just DM me or go to Facebook for Chalamaine Armstrong, and you can DM her for a lender. But if you're looking for a realtor, you can just give me a call, Labrita Dews, 817-975-9284. And remember, my show, Buying and Selling with Bri, is on the 3rd and 4th Mondays of the month. The 3rd Monday, I'm on for 30 minutes, and the 4th Monday, I'm on for 1 hour. Next month, we can try to get Ms. Chalamaine back with a different set of questions, or we'll see if she'll come back, next month. You would love to?
Yes.
Thank you so much again, Ms. Chalamaine, for coming. Thank you for everyone for listening. I hope this helped somebody. Apologies for going in and out. Apologies for me. I had my speaker on mute. Apologies for that. Again, thank you all so much for tuning in to Buying and Selling with Bri. Have a good week. See you.